I'm on the observation deck of the Empire State Building to demonstrate how much material Waste Management recycles. As North America's largest residential recycler, last year alone, Waste Management recycled 12.9 million tons. How much is that? Let's do the math. Carry the 6. It's enough to fill this building more than 27 times. With experience like that, we're bound to have a program that can help your business recycle. Talk to Waste Management or visit thinkgreen.com.
Do you want a free analysis of your inbound marketing? Do you want it in 30 seconds or less? Then check out Marketing Grader, the free marketing tool from HubSpot. It's simple. Just go to marketinggrader.com, enter the URL that you want to analyze, and Marketing Grader will instantly give you a detailed report grading your lead generation, mobile marketing, social media, competitive benchmarking, and more. It's simple, it's powerful, and it's free. marketinggrader.com.
Learn the most advanced recruiting techniques. Land the most desirable talent. Launch your company towards massive success. This is the Higher Power Radio Show with Rick Girard.
Feel the burn. So today we're talking about the importance of burn rate management at various stages of a company life cycle, specifically focused on the correlation between talent acquisition and planning. Then we're going to actually drop a couple of tips on how to hire talent during each phase. I'm Rick Girard, and welcome to the Higher Power Radio Show. Our mission is to discuss and deconstruct insights from top-performing entrepreneurs and industry experts. Every week, we uncover tested tactical solutions to solve your company's toughest hiring challenges. Today, our guest is Karl Hardesty, CEO and founder of Hardesty LLC, a national executive services firm providing both executive search services and on-demand executives to companies. The firm has built their reputation in the CFO space based upon their rapid deployment and experienced financial management resources through interim and project-based engagements. Karl is also specialized in other C-suite roles, including CEO, COO, CIOs. And he's an exact expert coming from the CFO world in this. So I'm really happy to have you on the show today. Karl, welcome.
Great to be here. Thanks for having me.
Absolutely. All right, so we're going to cover a few things. First off, I want to educate our audience as to what burn rate is, the importance of managing it properly, and what to expect at various stages of a company lifestyle. And then, really how to loop that into hiring and how to hire properly through each stage. It's a lot to cover. So let's, I actually did a Google search last night, and we're talking about, so I'm looking at burn rate, and the first thing that comes up is the rate at which an enterprise spends money, especially venture capital, in excess of income. So I'm going to let you chop that up. Is that correct?
That's a pretty quick, concise definition. Most emerging growth companies will be burning cash for their inception through sometimes as late as 4 years into their mission. Mm-hmm. So managing that is hugely important, and obviously if you don't manage your burn rate, you're going to run out of money.
Yeah,
so,
absolutely.
Capital is king when you're young.
So so let's talk a little bit more about burn rate and how that works at various stages.
Sure.
So run me through, let's run our audience through kind of the typical life cycle of a company. I start up, mm-hmm. I've got a couple bucks, I decide, hey, I'm gonna start up a company. And then I get some people that are interested, and they give me some seed money. Right. So that's the first phase.
Usually friends and family.
Yeah, friends and family, right?
We hope they remain your friends, too.
Yeah, as you always do. All right, so how does it, walk me through that process? So I get seed funding. What do I have to look out for? Basically that's usually to build a project or the product, and then it's just me working for free.
Exactly.
Yeah.
Or cheap. Yeah, so a lot of entrepreneurs, usually these entrepreneurs they're either salespeople or engineers, and they're going to develop a product or software. Let's just pick on software because it's sort of a hot commodity here.
Sure.
Another hot commodity here in Orange County would be medical device, right?
Yeah.
So you're an engineer, maybe you work for a large company, and you have an idea, or maybe you could make a better widget. So let's say you have a few bucks, and you're going to quit your job and invest some of your own money. you're going to watch that money very wisely.
Sure.
There's no money you watch more wisely than your own, right?
Yeah.
People get in trouble when they don't watch other people's money wisely. So, so you have a concept, you have an idea. Maybe you bring a couple of people with you, and if you think about that, okay, somebody's going to leave their day job and they're working for a big company, getting paid benefits. How are you going to attract that person to that startup company?
Yeah.
Is it the lure of cheap equity usually? Because it's not going to be a high pay rate, right? Because you don't have the funds to do it. In some cases, you're going to work free for a year. You and your co-founders are going to work for no wages for a year. That's the plan until you get something, and you're going to raise some money through friends and family. Maybe you know a rich uncle or something that would invest and like your idea. So that's getting off the ground. That's the
So you get off the ground and you go, okay, well I've got something going. At what stage maybe do you kind of transition that into Series A, and then I would imagine the burn rate becomes very important at that point, right?
Right. So in order to really launch a product and sell a product, you're probably going to need some permanent capital. Nobody's going to loan you money at that stage of your development, right?
Yeah.
So it's all going to come from typically VCs. So how do you attract a VC? There are specific VCs that invest in A round, which is your first round of institutional capital outside of the friends and family round. So it's going to be your second fundraising event. The first might come from yourself and your friends, but
or actually angel investors too.
Could be angel.
Kind of in between a little bit, right?
Kind of in between, yeah. So you could call an angel investor the A round, and then more institutional VCs your B round. But and ABCD just stands for the order of the money you're raising. So and there's different aspects at each different funding level and different investors that are going to come in at those different levels. But if you're going to pay wages and rent buildings and buy stuff, you got to have capital. So, so managing that burn rate, obviously, you have no revenue, so your only source of funding is equity.
Yeah,
coming from investors. So, if you think about it, what's the expenses during your first year? If you're paying wages, you have to pay wages. Maybe it's reduced wages.
Yeah,
office rent. You have to buy office equipment. Those sorts of things.
Software licenses,
computers. If you're a computer company, you're coding, you're sitting around, maybe in a small room like this with 5 people developing code.
Yeah.
Or maybe those people are overseas and you're just managing that development process.
Sure. All right. So when you've got that Series A round, right? I think that's usually when you start growing the company, right? That's when you start hiring on more people because you've got the resources to do it.
Well, typically A round would be maybe proving your product. I mean, coming out with a beta test of a product.
Sure.
One of my partners is involved in a startup company that it's sort of a picture-taking app that is really, really pretty cool. Their A round were all people in the business, in the entertainment and photography business, including a printer. And so all their initial funding, $2 million of funding, was for people they knew that would be interested in using that product.
Well, there's a question now. Would that be considered angel, or would that be really a Series A? I don't know.
Debatable. Yeah, I would say it's probably initial angel investors.
Okay.
And, because they're not institutional investors out where their job is investing in companies. These people were going to use the product to help develop the product, market the product, and had an integral part in the success of the product.
So Series A would really refer more to like that there is an institution involved in that round.
Yes.
Okay.
Yes.
All right.
Yes.
Just to clarify for some of our listeners. We have entrepreneurs that probably are getting started, so I want to make sure that they're clear on that.
Yes.
All right. So so you're at the Series A round. What do you have to look out for burn rate at that point?
Well, first thing, you're definitely burning cash, right?
Yeah.
So if you think about this process, in a growing company, you're going to be burning money for 2 or 3 or 4 years, most likely. So the goal is what's going to be the formula for getting your Series B round, right?
Yeah.
So typically the Series A investors will say, here's what you need to do. This money is going to be used specifically for this. Maybe it's to launch the product, a soft launch for a product. And if successful, we will invest in Series B, and we'll also bring along some of our more serious Series B type VC investors along with us.
Sure.
So there's a milestone you have to make, and it's it's really product development at that stage. You don't have a big sales force because there's really nothing to sell, right?
Yeah.
So you don't need salespeople yet. You're probably having a bunch of developers if it's software, or even if it's a medical device product. You're in the lab, building prototypes.
Mm-hmm.
No revenue, so you're just burning the investor's money.
Okay.
Hopefully in an appropriate way.
So then, you hit your benchmarks, you move through, you're at Series B, right?
Yes.
You're able to close Series B.
Yeah.
What are the pitfalls, or what do you got to look out for at that point?
Well, now you've got typically a less risky investor coming in who's not interested in doing that sort of proving development round. Now you've got maybe a real product. Maybe it's launched.
And you have some customers.
Maybe you got a few customers.
Yeah.
And now it's okay, we want to hire some salespeople. We want to tweak our product a little more. Now we've got some capital. And there's usually another milestone that, and believe me, before they were going to put in that money for the Series B, there's a use of funds that everybody's going to agree to.
Sure.
And, in that there are assumptions.
And those use of funds are not to fund your lifestyle.
No. We've seen companies do that, like going out and, purchasing, expensive office furniture. That's like the most ridiculous use of Series B money. You can go buy office furniture for pennies on the dollar, or leasing too much space, just buying too expensive equipment.
So those are some of the pitfalls you see at that stage.
Just inappropriate uses of those funds when it should be spent on labor and getting that product developed and or sales. But you don't need fancy offices. You have to stay in your garage for a while, or you don't need Class A office space. Be in C or B office space.
So what is, I know you want to provide, especially these days, you want to provide a great working environment. You want to be able to attract talent. So what is the, where's the tipping point as far as buying nice office furniture? I mean, what are investors cool with, and where do they have a problem?
Great question.
Yeah, especially when it comes to the burn rate. I mean,
absolutely.
It's going to burn through a lot of money.
Yeah. So in this environment, think about this environment. We have a super low unemployment. I think Orange County is 2.4%. I think for college-educated people, it's even less, which is almost zero unemployment.
Yeah.
So competition for any sort of worker is highly competitive right now. So what's going to attract that worker to your new startup company? So it's either going to be somebody somebody who believes in your vision, somebody who's sick of working for big company and wants to be early employee with a company they see, getting big where they can participate in the equity. That's what's going to attract those employees. Those employees are going to be more risk takers, and those are the kind of people you want. They want to sacrifice a little bit of their wages, get some of that equity, and then participate in that growth.
Sure.
It's a different type of employee. It's not going to be that employee that needs a stable, high-end paycheck.
Yeah. But I mean, I guess that's so. When we're talking about the office furniture and the other expenditures, right?
Mm-hmm.
Labor is going to be the biggest cost that most companies are going to have,
right?
But when you go all out and put $1 million into an office space and you got too much office space, I mean,
you can't afford it at that stage.
Yeah.
So you have to attract those people without that fancy office, without the ping pong table in the corner, without free lunches in a cafeteria. Some of these big companies have. So
you're looking for buy-in at that stage.
You're looking for buy-in.
You got to connect with people emotionally.
In a different level. It's not the high pay or the fancy office. It's going to be something else. And
in this market, when you have a really low employment rate, it's tough because you have all these companies that are out there that are throwing lots of money at people.
Absolutely. I mean, it's very tough for the large, successful companies, the Facebooks and Googles and all those big companies that have plenty of money that got fancy offices. They have trouble attracting employees. And, there's really no loyalty with the employers anymore, so the employees view themselves as free agents, which they are. Yeah. And they'll move after 3 months for, five minutes closer to my house.
Yeah. Well, and we'll talk about this on the back end of the show, but I found that, money usually is fourth or fifth down the road.
Yes.
A lot of times with most people. But
yes.
All right, so now we get past this Series B and we get into, we're maybe a company that's generating quite a bit of revenue. When you're raising your Series C round, I mean, where are you typically there?
Well, usually, if you've been successful with the B and spent the money right, and you're in a market that's attractive, you're not going to have a problem raising Series C round. The question is, if you're the owner, founder, how much equity do you have to give up for that that C round? So it becomes a big valuation issue.
Sure.
So the VCs are going to have their way. They're going to value it. The seller, who's going to sell a piece of the company to the round C investor, they're going to have their valuation. So you're going to have a discussion, a meeting of the minds on what that's worth, where that's going. It depends on the market you're in, and again, usually at that stage, if you brought in B round investors and things are going well, they're going to want to participate in the C round as well.
Yeah. Well, isn't that typically a C round is where you're really scaling too? You're
scaling. That's when you're hiring salespeople, more programmers. You're refining your product. Now this is where you would have enough money to come in and start paying market salaries.
Sure.
Having better benefits that a big company might have. You have maybe a little bit. You've moved into a different building now, and
it seems to me like this is probably the stage though where burn rate is most important.
Yeah, you're burning more money. Think about it. Now you don't have 10 employees now. Now you have 100.
But you also have to balance that influx of cash. I mean, it's a lot more tricky at that point.
It's very tricky. So just from I'm a CFO by trade. So so you think about, okay, I have to tell my investors how much money we're going to burn over the next 12 months. Okay, depends on our revenue ramp up. Depends on how many people we hire. So look at this. If I can't hire salespeople to increase the sales, I'm going to miss that projection.
Yeah.
And then if I'm hiring other people, maybe we can hire other people quickly, and we've got other people, coders, that are just incurring wages and so on. I'm going to miss my revenue number, and my burn rate estimate is going to go through the roof.
Yeah.
So it's a real hard thing to manage because you don't know what the ramp up's going to be, and there's so many factors. So again, in this tight employment market, if you can't hire quality salespeople, on your scheduled times, then the sales aren't going to ramp up, and then your burn rate's going to be excessive, and you're going to, you're going to have to go talk to the board about, hey, I missed the burn rate. We need more money.
That's such great insight, Karl. So we're talking to Karl Hardesty, the founder and CEO of Hardesty LLC. We're going to take a quick break. We've actually just covered burn rate and kind of what it is. When we come back, we're going to talk a little bit more about kind of the importance of burn rate, especially on different levels, and how to properly recruit talent through each stage. We'll be right back.
You're listening to Higher Power with Rick Girard, giving you access to recruiting techniques that will help you hire key talent to build your company towards real success. Rick is a recruiting executive and entrepreneur who's been successfully recruiting in the aggressive Silicon Valley technology landscape for the past 2 decades. After a very successful stint at Apogee, he founded Stride Search in 2012. Based on a lean efficiency model, Stride has uniquely positioned itself as a leader in retained search for the most critical talent hires within a small organization. Whether you're a startup executive or recruiting professional, by listening to Higher Power with Rick Girard, you will walk away with skills to help you attract and hire great talent. Now back to Higher Power with Rick Girard.
And welcome back to the show. I'm your host, Rick Girard, and you're listening to Higher Power. Today our guest is Karl Hardesty, the CEO and founder of Hardesty LLC. And we're discussing burn rate and the importance of kind of managing the burn rate at different stages of company. Now we're going to explore kind of alternative kind of resources and how to properly kind of recruit and find those talents at each stage. So during the break, Karl, you and I were talking a little bit about kind of a piece of this will lead into recruiting, which is outsourcing, right?
Yeah, outsourcing can be incredibly efficient as you're growing your company. Example might be outsourced accounting. Do you need to hire an accountant early on, or can you push that out to a firm that does accounting?
Yeah, in today's market, that's a lot. Like I've seen a lot of fractional HR and fractional CEOs.
Yes,
and
there's
COs,
fractional everything.
Fractional recruiters.
And it's very efficient. There's, I always make the argument that you might need a CFO. You might not need a CFO 40 hours a week. You might need a CFO 10 hours a week, 10 hours a month. A lot of people don't know that that's available, and it can be an incredibly valuable skill to add on a part-time basis as you're growing.
Well, I would imagine, especially when you're young, when you're a young company, because you're going to make a lot of mistakes. You're
going to make a lot of mistakes. And we see a lot of mistakes being made where if we would have been there, we would have said, don't do that. That's not a good use of the funds.
Yeah. So, let's talk about that. You're a seed friend and family, funded, or maybe 500 startups got nice enough to, throw some money in your company. Hiring somebody who's an expert outside of what you're doing is probably the wisest thing you can do with that money, I would imagine.
Absolutely. I mean, take leasing a building, for example.
Yeah.
I mean, you're going to grow. Let's say you've got an estimate. You're going to add 50 employees next year, 50 the next year. You don't take down all the space for 100 employees. If you can, you'd want to take down space and stage that lease or that rent expense. Now, can you always do that? No, you can't always do that. I've got one friend right now. He had to take down an entire building. He's doing a medical device. It's not a startup, but it's emergent growth.
Okay.
He had to take down an entire building, even though he's not going to occupy that building probably fully for 2 years.
Oof.
Yeah, just
so
because
he's got to eat a lot of rent on that.
Yeah, he's got to eat a lot of rent. He knows it. Their investors know it, but that was the option here in Orange County.
Got it. Yeah, and space also is very limited here as well.
Very limited. I mean, some of the industrial space is like non-existent. So.
All right, so let's break down. Let's say you just get some money, right? What do you need? What would be the prudent thing to do with the money you're spending? Hire out a fractional, CFO to help you really get the financial structure in place?
Well, you might need, if you think about basic, you're probably going to need like an executive assistant, right?
Sure.
Okay, one of the things that is really popular lately is professional employee organizations. So you can actually hire your employees, but they're actually in another organization. And through that, you can get better benefits for your employees. You can get big company benefits.
Is that like a PPO or something?
Yeah. Well, it's a PEO, professional employee organization. Right, okay. So they're called co-employment, but there's a lot of firms that do it. There's firms that specialize doing it for tech companies. But what you get with that is all the compliance, because trying to be compliant with employee rules in California is almost impossible.
It's ridiculous.
So
yeah.
with the PEO, you're going to get access to a trained compliance HR executive. You're going to get access to bigger benefits, and they manage all your payroll. So you just write them one check a month, and they pay all your employees. They're your employees, they're employees, but they call it co-employment. That's a really efficient model for a lot of companies, rather than trying to do your own payroll.
Got it. Okay. So recruiting. Let's talk a little bit about that. I mean, I'm a seed-funded company. How do I get people to join my company? I mean, you actually touched upon that in the first part, but
right.
You don't have any money to pay them, so you really gotta have a good.
You have to be a charismatic entrepreneur.
Yeah. And you've got to find the people that are passionate about what you're building.
Right.
I mean, if somebody's gonna, like you said, if somebody's gonna give up something.
Right. Now, normally, before you go ahead and start your own firm, you might have had that discussion. Let's say you're with a company, and a group of you are going to go leave and start your own company. You've got a little bit of a team, that's going to leave and go do that.
Sure.
If you're just starting your own company in your garage, you're going to try to attract employees. That is really difficult.
Yeah.
So what I would say is, be very visible, be visible in your industry, be visible in the business community, and you'll be able to attract employees, potential investors. Don't hang out in your garage all day long.
Yeah. All right, so let's talk a little bit about that. How do you be visible here in Orange County? I mean, there's lots of...
Orange County is an easy place to be visible. There's so many great organizations that you can join, industry associations or specific, M&A organizations. I'm a member of Association for Corporate Growth, which is all about financing and selling and preparing businesses for sale.
Okay.
It's just a fantastic way to meet people. But there's chambers of commerce. There's all these. There's startup type organizations. There's a group called Octane.
Octane's a great
organization. So being visible in those, meeting other people, that's where a lot of your first employees are going to come from. People you meet in those circles.
Yeah, most definitely. And getting those that network and building up that network is huge. I've been investing a lot of time in the past couple of years doing that as well, since I'm fairly new to Orange County. So.
Yeah. I mean, I found employees myself through these various organizations.
Yeah, absolutely. All right, so we get into kind of your first round of funding, Series A, and I always find that this is my favorite stage because the company has money and they can pay me.
Yeah.
But also, I think the opportunity for growth, if you really package things properly for the right person, the money becomes kind of secondary. But this is like, again, the big draw at these two phases is primarily the equity for most people.
Yeah, equity. Everybody always wants to tell the story. I was employee number 3 at, ABC Success Company that went, ballistic and was sold for $1 billion. That's everybody's story. That's the type of people you're gonna attract at that stage. They're still going to need some pay. I mean, most people who are, let's say, in their 20s or 30s can't afford to, unless they're living with their parents and their parents are completely providing for them, are going to need some money. Yeah. But they'll work for a, below a fair market value wage in exchange for some equity.
Yeah.
They won't do it forever, but,
And I usually see like about 50-50 split of people at that stage that like will actually take less salary in exchange for more stock. They'll cut their salary for stock equity.
Right.
Sometimes people don't just because of whatever family constraints or what have you.
Yeah, some people just can't afford to do it. Their situation is they just can't. They need the maximum cash comp they can get.
Yeah.
So they're going to stick with the larger companies that can pay more. But they're not going to make any money on the equity, right?
Yeah, that's very true. Yeah. So, and again, at this stage and even kind of Series B stage, I think they're both fairly similar. I mean, those are usually when you're starting to shift into more growth. You're still one of the early employees. There's still that buy-in that you have to engage people emotionally to make it a non-transactional, or non-monetary compensation. And,
right.
As kind of Lou Adler calls it.
Yes. These days, some companies can get significant Series A funding. I mean, we're talking about $10, $15, $20, $30 million of Series A funding. Mm-hmm. With that amount of capital, the investors might say, I want you to go out and hire a top engineer and do what you have to get that person on board. And, they'll have a range of comp, and the more cash comp that person demands, the less equity they're going to get. But they'll be able to, if they need to, they'll be able to pay fair market value wages for that executive, and they'll make a compromise on the equity because it's really important at that stage. So even early on, some companies will have the funds to pay those salaries. Not for everybody. They have to make that stretch that Series A funding as far as they can.
Yeah.
But for certain positions, they will make that investment if that's what they have to do.
Sure. Well, really in between seed funding and Series A is really when you need to start building out your executive team, right? Because you're not going to get a Series A most likely without an executive team on board.
You might have a partial executive team, or some of the Series A money might be able to go complement the rest of your executive team. So let's say you had the founder. Let's say the founder is an engineer with some decent sales skills. Okay, what do you need? Maybe you need a COO to really manage all the other stuff, and you're going to deal with that for the first year. You're not going to go hire that CFO or that sales guy or the HR person or whatever it is for a year. That's going to be the plan. You're just going to have to get by without it.
Yeah.
And then you hit a certain stage, and okay, we're going to hire this executive.
Well, at what stages though, like in the funding stage, do typically you see that we've got a founder. Founders really kind of we've got our founding leadership team. They're kind of over their head at this point. I mean, we need to bring in a professional to kind of handle things. Mm-hmm. Is that usually like after Series B, Series C when they're really pushing for kind of scaling the company?
Yeah, C's really, you've got a product now. You're going to blow that product out, right? Yeah. That's where you're going to hire a national sales team. You're going to open offices around the country or maybe around the world. We got a local company here that this was in they did that in their D round. They picked up $40 million from a Class A, world-class investor, and now they're building out their international sales team. Mm-hmm. But they're still hiring coders and ramping up, and they're still burning a lot of money.
Yeah.
So, but it's like it's a market grab for customers right now, and the goal is signing up customers, keeping that revenue growth rate going.
Got it. Oh, man, I wish I had a little bit more time, but I'm getting the signal from Paul, our engineer, that we're running out of time here. So, Karl, thanks again for your time investment and in the show today and sharing your knowledge. It's been great having you.
Thank you.
And welcome to the Higher Power Radio community.
Yeah.
Now, I'm sure some of our listeners are going to want to reach out, especially for some of your services. What's the best way for them to reach you?
Well, we have a website, hardestylc.com,
Okay.
and all of our contact information is on there. We have an office here.
Spell Hardesty if you could.
Hardesty is Hardesty.
Okay, .com.
It's British, by the way.
All right.
From what I've been told.
Nice. And what people, I mean, who would be wise to reach out to you?
Well, any founder who wants some advice on hiring or financing, growing, and we do a lot of, we'll do some pro bono work for people just getting off the ground. Sure. And most of our clients are funded. They've either gone through an A, B, or C, or D round, or they're founder-owned or family-owned, and they're getting ready to grow and add an executive. But we have all types, and we're primarily a middle market and lower middle market type company, although we've got a couple clients over $1 billion. But
excellent.
Orange County is a middle market and emerging growth marketplace.
Yeah. Well, we're the 5th largest county in the nation, right?
Is that true?
I think so. Something like that.
Yeah.
So with that diversion, I want to thank our listening audience for tuning into this week's episode of Higher Power. A quick thanks to our team, our engineer Paul Roberts, our producers Andrea Ballin, Shanti Ryle, and our executive producer Kim Iverson. To listen to this show and any past episodes, you can check us out at Higher, that's HIRE, powerradio.com. There's 2 R's there. Or Higher Power Radio on iTunes. Follow us again also on Facebook and LinkedIn at Higher Power Radio Show. Or you can follow me on Twitter at Rick_Girard. So we have another really good show lined up for you guys next week. Our guest is going to be Craig Cook, the co-founder and CEO of Rhythm Interactive. I'm your host, Rick Girard, and you have been listening to the Higher Power Radio Show. Aloha.
Thank you for listening to Higher Power with Rick Girard on OC Talk Radio.